Most taters see a bear market and they just head for the hills, right? Their main goal is to protect their capital. And hey, nothing wrong with that, but let's be honest. Sitting on the sidelines can get, well, pretty boring. What if you could actually look at a downturn and not see a threat, but a real opportunity? Okay, let's get into it, because trading the bear is, frankly, a lot more fun.
So for the longest time, the smart play was all about defense. You'd get out of the market, avoid those nasty drops, and you know what? It worked. It saved a lot of people a world of pain and protected their capital. But the ITM strategy is a bit of an evolution. We're shifting from that defensive crouch to more of an offensive play. We're going to learn how to actively trade these declines.
To make this happen, we need a tool, and that tool is the MACD. Now that stands for Moving Average Convergence Divergence. Quite a mouthful. It's probably one of the most popular indicators on the planet. But here's the catch. It's also one of the most widely misunderstood. Seriously, almost everyone has it on their charts, but you'd be surprised how few people actually use it correctly.
Okay, so let's break down the MACD. And right away, you're going to notice the names are just wonderfully confusing. You've got the MACD graph and the MACD line, and yep, they are both lines. You really have to wonder who came up with this stuff. But thankfully, the third part, the histogram, is easy to see. And for what we're about to do, it's the only part that really matters.
So you always see the MACD with these same three numbers, 12, 26, and 9. They seem kind of random, don't they? Well, they're actually a relic from the past, back when we had 6-day trading weeks. Now, we could definitely update them, but we don't. And why not? Because literally thousands of traders are still using these exact same settings. So when they all see the same signal, what do? They all act on it at the same time, creating this big self-fulfilling prophecy. We're not just trading numbers here, we're trading the crowd.
All right, so if everyone is looking at the same thing, what's the big deal? Well, the problem isn't what they're looking at, it's where they're looking. Most traders are focused on the completely wrong signal, and it leads to so much frustration and a lot of bad trades. Let's break down exactly what this common mistake is. So here's the textbook way to use the MACD. You watch for the two lines, that graph and that line, to cross over. The fast line crosses above the slow one, you buy. It crosses below, you sell. I mean, when you look at a chart after the fact, it seems so simple, right? But in live trading, it's total chaos. You get all these constant, conflicting signals that just whip you in and out of the market. It's a mess.
And here's a perfect example of what I'm talking about. In 2021, during a period where the market was just steadily climbing up, the standard MACD crossover method gave, get this, 11 different sell signals. Can you imagine acting on every single one of those? You'd have been shorting a rising market over and over again, just getting stopped out, losing money. It's a complete recipe for disaster.
Okay, so if those crossovers are just a bunch of noise, then where's the real signal? This is where the ITM strategy completely changes the game. We are going to totally ignore what everyone else is obsessing over, and instead, we're going to focus on the one part that gives us a true read on momentum.
And here's the secret, plain and simple. For the ITM bear strategy, you completely 100% ignore the MACD graph and the MACD line. Just pretend they don't exist. They are irrelevant. The real key is to focus only on the histogram. In fact, most charting software will let you just hide the lines completely, which I strongly recommend you do. It just clears away all that noise and lets you see what's actually going on. So reading the histogram is actually pretty straightforward. It gives us a much cleaner picture through 4 simple states. See, when it's positive, above that zero line, and the bars are getting taller, that means bullish momentum is building. If it's positive but the bars are getting shorter, that bullish momentum is fading. And the exact same logic applies below the zero line for the bears. It's a way cleaner, way faster read on who's really in control.
Okay, so using the histogram is a massive step up, but the MACD has one big built-in flaw that you absolutely have to know about. If you ignore this, you can end up making some really serious mistakes.
So what's the catch? Well, unlike a lot of other indicators that work on a nice, clean 0 to 100 scale, the MACD is not normalized. What that means is its values scale up and down directly with the price of the stock. So, a MACD reading of, say, 0.5 on one stock is not at all the same as 0.5 on another. The raw number itself is basically meaningless without context.
And check this out, because this makes it perfectly clear. On the left, you've got Ford, a $12 stock. Its MACD histogram barely budges, moving between plus and minus 0.16. Then on the right, you have Berkshire Hathaway, a stock trading for over $700,000 a share. Its histogram swings by thousands of points. So a similar percentage move in the price of each stock gives you a wildly different MACD value. You just can't compare them.
So what's the bottom line here? The MACD histogram, it's an amazing tool for spotting shifts in momentum, way better than those noisy line crossovers. But, and this is a big but, because of that normalization problem, you can't use it all by itself. It's one critical piece of the puzzle. But to build the complete ITM bear strategy, you have to pair it with another indicator. And that leaves us with the big question: which one?